All right, folks, quick segment here for you. By quick, hopefully it's not going to last more than 20 minutes. But anyways, here's a phenomenal comment by the viewer, and I was waiting for somebody to actually ask or comment on this, but here it is. It says, you tweeted, for bulls who say recession is canceled, as if that is a good thing. Remember that the advance in equities is based on the Fed backing off out of fears of causing a recession. Your enemy is reinflation, not the recession. With reinflation, there is no backing off. The viewer says it seems that you're flip-flopping a bit between recession and reinflation, meaning when it appears that the economy is doing well, you say the risk of reinflation, but when inflation is cooling down, you say it is for the wrong reasons, aka the recession. In the meantime, neither seems to be materializing. But since the risk of one increases when the other abates, you keep switching between both as the main risk as the underlying thesis for your fundamental bear case. Now, this is a really important comment because it suggests that perhaps the bear case seems to be hypocritical, but we'll explain why it seems this way. Yet another important point, if I'm being defensive here, when we talk about the bulls, if you remember last year, everybody was saying the Fed has to back off because of the lag impacts. The lag impacts will slow down inflation, and if the Fed doesn't back off, the lag impacts will take us into a recession, if not a depression. Now that we have a stock market mania, nobody talks about the lag impacts anymore. They don't even mind that the Fed is going to raise 2 more times on top of what they did this year and last year. So that's an important one that we have to talk about, but I'm not the one floating it, so I'd leave the question to the bulls. What happened to the lag impacts? Now, when we talk about the risk to the economy and the stock market, the number one concern is the Fed raising rates aggressively. And so long as you can see the end of that, the stop of that, you can at least have a clear picture of what's going to happen to the economy and the market. But so long as the end of that remains unknown and open for more and more hikes, that's where the majority of the risk lies, that the Fed will keep raising until something breaks or until they cause a severe recession across the economy. So when we say that the recession is not your enemy if you happen to be bullish to the stock market, at least not right now, in the long run, it is your enemy. It shouldn't be your friend. It's not your friend. But in the meantime, every time we have bad news, recessionary news, what is the impact of that on the monetary policy? It gets us closer to the end because the Fed doesn't want to raise rates aggressively until the economy breaks into a depression. The moment they see signs of a recession showing up, specifically the unemployment rate, they back off. So if the whole thesis is let's go bullish the stock market because we see the end of quantitative tightening, then more bad news, aka recessionary news, is actually good for you, at least in the short term if you happen to hold this view, because it gives you visibility to the end of quantitative easing because we see a lot of recession impacts going on in the economy. On the other hand, if we start to see reinflation in home prices and goods prices and services prices and commodities prices, then what does that do to the monetary policy? The answer is it gets us to the unknown territory, that they could keep raising rates over and over and over and over. And that increases, believe it or not, the probability of a recession. So they're all intertwined, they're all connected, but the risk of reinflation is the enemy if you happen to have a bullish view on the economy and the stock market because rates will keep going higher. And any rational observer knows that higher rates, this aggressively, this fast, for a longer period of time, will increase the recession risk dramatically, but also increase the risk of a systemic event. I mean, look at what happened to Silicon Valley Bank. I would say that was our Bear Stearns. And then as the Fed keeps raising rates, we're going to get our Lehman. But if you look at the case of Bear Stearns, and again, the case of Silicon Valley Bank, when these events took place, the Fed backed off. This year, the Fed launched all of these lending facilities to banks, which a lot of observers confuse that as resuming liquidity by the Fed. But the same thing happened back in 2008. The collapse of Bear Stearns pushed the Fed to back off even more. They've been backing off because of the real estate sector, but Bear Stearns really pushed them away. And if you recall back then in the aftermath of Bear Stearns' collapse, the Federal Reserve cut rates by 75 points. They were cutting by 50 before. They cut by 75 points, and the market rallied. And in the case of SVB, the market rallied. What is the reasoning behind that? Investors look to the end of quantitative tightening. They look for easier monetary policy, which supports higher equity prices and higher asset prices across the economy. That's the assumption, of course. But then what about the lag impacts from the Fed raising rates all of those years before Bear Stearns? Well, we got Lehman, we got AIG, we got Washington Mutual. And in this episode, we got Silicon Valley Bank, we got FRC, but we're going to get more as rates keep going higher. This is riskier than before because in the 07-08 episode, inflation actually went down. It was not a major problem to begin with. It was a major problem in energy prices, but not as we see today in this episode, which means in the 23 episode, the Fed will continue to raise rates, increasing the prospects of recession and systemic risk. And if we have reinflation in the economy, those risks also move higher. But let's take it one step at a time and connect it all together. We go back to 2020, the pandemic hits, the stock market crashes, and the Federal Reserve responds by unleashing the biggest wave, the tsunami of liquidity that we've never seen before, the biggest wave of liquidity in human history. And when we look back on why we got this inflation, it was because the economy was hot to begin with. In 19, even in the first quarter of 22, the economy was really hot. Unemployment was way too low. And if you recall, back in late 2019, early 2020, we were actually talking about the risk of inflation in the economy because the Fed backed off in 2018. Stock market shot up higher. We started to see asset prices rising higher. Believe it or not, folks, go back to 2019, fourth quarter, first quarter of 2020. We were actually talking about the risk of inflation. But then came the crash, the pandemic. And the Fed responded by issuing all of this liquidity on an economy that did not really need that much liquidity. It was an artificial crash, an artificial recession done by the lockdowns. We could have targeted that surgically to help the leisure and hospitality businesses, small businesses in the economy. But it wasn't like we saw the unemployment rate across other sectors rising higher, or economic activity or demand just crashing. Demand actually increased higher. So when we look back, we're going to realize that the Fed overstimulated an economy that did not really need that much stimulation. Not to mention, of course, all of the packages from the fiscal side. And now we have, $200 billion missing in the PPP loan program. We have over $200 billion that was abused in the PPP loan program. So we're talking about, almost $500 billion in fraud. But the end result of all of that was inflation. And now, to remove inflation out of the economy, the Fed will have to do two things. Classic things that the monetary policy always done to remove inflation out of any economy. Number one, you have to slow down demand in the economy. Number two, you have to remove the excess liquidity out of the economy. Let's take them one step at a time. Slowing the economy, you do that by raising rates higher. If rates go higher, the cost of borrowing by companies goes higher. So capital expenditure slows down. The assumption is that the cost of borrowing on credit cards will also go higher, so consumer spending will slow down. The rate of new purchases will slow down because if you want to buy a house, if you want to buy a car, a washing machine, that's going to cost you more now because rates keep going higher. Now, there is another way that increasing rates also slows down an economy because we see rates on cash holdings increasing. We see rates on bonds increasing. So a lot of the money that's sitting on banks that could be deployed for demand in the economy by buying stuff actually gets locked in cash accounts, in bonds to receive higher interest rates, and that slows down the economy. And this point is connected to removing excess liquidity from the system because when you have all of this money chasing cash accounts and chasing bonds, this is liquidity that's going to be stuck in these investment instruments for a while, a year, 2 years, depending on your bond or your cash holding, and you're not using this money to spend in the economy. But the Fed can also remove excess liquidity by the classical method of reducing the M2 money supply, which they've been doing aggressively, and a lot of folks who believe that the recession is going to happen, and if you're rational, you know that the end of all of this is a recession. The end of the cycle is marked by a recession. The end of any major inflation episode ends in a recession. But Team Recession will point to the M2 money supply as a warning. Look, a major drop in M2 money supply like this, it will get you a recession. You're just waiting for the lag impacts. But another way you can remove excess liquidity in the system, and this happens organically, is stock market manias. The job of a stock market bubble is to remove the excess liquidity out of the system. So you have all of these investors chasing a bubble, a mania. Their money's now locked into that lotto ticket, and they keep seeing it growing and going higher and higher and higher and higher. But then, as any other bubble, it stops making sense, and we start to see the insiders dumping their positions. We start to see the shorts piling in, betting on the other side, and the bubble crashes. In the crash of any bubble, the wealth is transferred from those who chased the bubble to those insiders, the C-suite, the oligarchs, the owners of these companies, and of course the hedge funds who end up shorting these bubbles. So when we look at the stock market bubble that we have right now, we can call it the AI bubble. Although it has many other fronts besides AI, such as housing and construction, It's the stock market's job of removing that excess liquidity. And it tells us that we have plenty of excess liquidity that has to be removed. And the question now becomes, for how long? How high and how long will Fed funds rate will have to go before we see a legitimate slowdown in the economy that is inclusive? Number one. Number two, how long and how aggressive will tightening the money supply has to go before we see the excess liquidity removed out of the system? And the other question is, how high and how insane does the stock market bubble has to go before removing all of this excess liquidity out of the system? And the key to answering that is understanding the icy hot phenomenon in the economy. You see, in 2020 and 21, everything was hot under inflation. Every sector of the economy was white hot. And when the Fed started raising rates aggressively and tightening the monetary policy, what did they got so far? They got the icy hot phenomenon. So when we talk about the icy in the economy, we can talk about manufacturing, we can talk about commodities going down, we can talk about shipping costs going down, we can talk about transportation costs, trucking, for example, collapsing. We can talk about retail spending. Retail stores are closing. If you look at the earnings trends from these retail companies, and we got some of them, we got Nike, for example, they're looking abysmal. Then we have goods, and of course, goods are in the icy category for now. Now, when we look at the hot category, we can put housing under that. Housing remains really, really hot. Construction is really hot. Matter of fact, construction spending is now at record highs. If we look at leisure, hospitality, travel, just look at what's going on this weekend. It's mania across the airports. So we know that's hot. We look at services. That remains too hot. Look at core services CPI, X energy. That's at 6.6% right now. We look at food. That remains too hot. Labor. That's too hot. And this is happening for reasons that we do understand and reasons that we don't understand right now. For example, when we talk about housing, we have massive supply shortages right now. And since a lot of these potential home buyers been saving money for years, they have this money in the account right now. It's just the opportunity is not here. The supply is not here. But the moment we see new homes hitting the market, they sell out like hotcakes. And so long as the labor market remains intact, those folks are not going to hesitate to buy these new homes at 7% mortgages. But if they start to lose their jobs, that calculation is going to change. So they're all kind of connected. When we look at construction, for example, the fiscal spending is on fire and it keeps that sector hot. But we also have reasons that we don't understand right now. Why do we see the icy hot phenomenon in the economy? However, the most important thing to understand is, what would the Fed do right now? When we talk about, you're flip-flopping between reinflation and recession, it comes down to the icy hot economy, and it comes down to the Fed policy. If the Fed decides to relax right now with the stupid pause that they've done recently, and they keep signaling that, the end is near, what's going to happen is we'll see all of these icy category becoming hot again. And you already see categories such as used cars in between. They go cold for a little bit, and they reinflate again. And if you looked at the recent data for durable goods, that's also kind of reinflating again. A little bit, a tiny bit. But we can see the signs. We've also gotten a recent rebound in retail spending. A tiny bit, we can see the signs. We've seen a rebound in commodities prices across the board. Tiny bit, we can see the signs. You're also going to notice that a lot of the manufacturing PMIs and the services PMIs will start to improve again. And a lot of folks will say, look at this, the soft landing is here. But folks, things are not going to recover without inflation. It is delusional to say that equities, bonds, manufacturing PMIs, retail spending, small business optimism, all of that's going to rebound without a rebound in inflation, because inflation is still with us. Inflation is still embedded in the psychology of this economy, and the cycle is not over. So if the Fed relaxes, we're going to see the risk of reinflation happening, because if you watched my video on commodities, for example, the fundamentals are solid. The only thing that took these commodities down is the assumption that the Fed will do the job and the Fed will crack the economy down into a recession. And of course, when SVB collapsed, those bets against commodities also increased because the probability for recession increased. And that's another important point. When you look at the stock market, it points out for expansion coming. You look at commodities, at least until recently, they were pointing out for a recession. If you look at the bond market, it is still pointing out for a recession. A lot of folks look at commodities and the bond market being bigger than the stock market as more of a reliable indicator of what's going to happen. But anyhow, the risk of reinflation happens when you see these categories in the icy heating up again because the Fed is backing off prematurely. Now, suppose the Fed does the job, be it on their own or after they see reinflation in the economy, as, by the way, we've seen earlier this year. If you recall, January, February, all of these CPI readings came out hotter than expectations. So the process of reinflation was already here until, of course, it got disrupted by the collapse of Silicon Valley Bank and credit tightening. And then the odds of a recession increased and took over the odds of reinflation. Now I see the opposite. I see the risk of reinflation taking over the risk of a recession. Now, that doesn't mean that the risk of a recession is going down, but it means that the risk of reinflation is more likely than the risk of a recession right now. But suppose the Fed does the job because or absent of reinflation. What does that requires? A lot of aggressiveness, raising rates to 6-7%, tightening the monetary policy even more, and then we see the categories in the hot becoming icy. So we start to see housing, construction, leisure, services, food, labor, all of these categories slowing down and heading toward becoming icy. Then the Fed will succeed in defeating inflation, but the price would be a recession. And one would argue it could be a severe recession because all of these categories that were icy to begin with, such as manufacturing, for example, they will get hit even harder as the Fed keeps ramping up the fight to take housing, construction, leisure, food, labor from the hot to the icy. So now you begin to understand that it's not really flip-flopping. We have two risks right now. It depends on what the Fed does. If the Fed relaxes, we're going to get risk of reinflation taking over. If the Fed continues to go on and doubles down, then the risk of recession will take over. And of course, in between, we have the risk of systemic risk because we have a lot of debt in the economy that has to be refinanced at higher interest rates. A lot of these companies are zombie companies, profitless companies, and companies that cannot really handle these high rates for too long. Now, absent in all of this is the consumer. Is the consumer icy or is the consumer hot? We covered this in details before. We made a video about it. The US consumer is weakening dramatically, even in the affluent consumer category. If you look at the Bloomberg Luxury Watch ETF, that's going down. If you look at spending on jewelry and diamond prices are down. If you look at the data from Amex, the spending is also going down among the affluent consumer. And of course, the poor, the lower middle class, they've already got annihilated. And now when we look at the earnings from Nike, from General Mills, all of these companies that are showing that the consumer is getting weaker and they cannot really handle the rise in inflation and higher prices, what does that say? What does that suggest? It suggests that the consumer is actually moving toward the icy category. And consumer spending is the main key. If consumer spending slows down, then you're going to start to see a lot of these categories moving rapidly from becoming hot to the icy. And the economy will indeed face a recession because if consumer spending slows down and we see corporate earnings going down, we will see more and more layoffs, not just in tech this time. And unemployment has been the key to defeating inflation, traditionally speaking, because it takes the excess demand and the aggregate demand out of the economy. The problem is, we cannot just assume that the consumer will become icy so fast, because so long as the consumer has jobs and they can slow down for a little bit to pay their credit cards, and then reuse them again. We've seen this phenomenon, by the way. We've seen this year. We see retail sales, they go down for a month or two, then they rebound higher all of a sudden, which means that so long as the consumer is employed, they will maintain inflation higher. Now, we have other factors such as student loan debts that have to be repaid in September. That's going to slow down consumer spending even more. So that goes in the bucket of the recession. So now you begin to understand that this is a fluid situation. It's not easy to conclude one way or the other that, oh, the consumer is going to push us into inflation or recession, because we have data that supports consumers driving the economy into a recession by slowing down spending, by having to repay student loans, for example. But then on the other hand, they still have their jobs, at least right now. And so long as they have a paycheck, they can maintain inflation higher. On top of that, another important point. Because the consumer is diverse. You have middle class, upper class, lower class, different tastes and means of spending. And we have a huge cohort of consumers who have in their savings right now money that they intended to buy a house with, to buy a car with, to buy big ticket items with. And if they realize that prices are not going to go down anytime soon, and oh, by the way, the Fed will raise rates higher, and 7% mortgage rate is actually better than 10. What does that do to the psychology? The consumer will think, at least that cohort of the consumer will think, oh my God, I got to buy a house right now before it gets even more expensive. And therefore we see the stampede of new homes and the signs that we see in reinflation in goods, in the prices of cars. So if you want to go crazy, we can segment the consumer into different segments, some in the icy, some still in the hot, and until the hot category of the consumer becomes icy again, inflation will not be defeated. Again, it is a complex issue, but we have two tail risks here, inflation in a recession. And anybody who dismisses the risk of reinflation, they need a history lesson. They need to go back to school. Every inflation episode that we've seen before, a major inflation episode like we have right now, we've never really seen a V-shaped drop in inflation. It spikes, then it goes down all the way to the target without a systemic crash. We usually have rebounds in inflation. And if you look at core CPI, it went down a little bit, but it remains sticky. Who's to say that's not going to move higher again when you consider all of these things that we just talked about? So in conclusion, it's not really flip-flopping or moving from one theory to the other. They're all connected. We know that the inevitable destination is a recession. The question is, how are we going to get there? Are we going to get there right away with the Fed being aggressive, doing the job? We see unemployment rising higher. That would mark the end of inflation, the beginning of the recession. Or are we going to see it after a period of reinflation, and then the Fed will come out more aggressive and take us into a recession? Or are we going to get into a recession because the Fed is raising rates and the lag impacts will cause a systemic risk? That blows up, crashes the market, crashes the economy, and now we have a recession. So now you see that recession is the inevitable, and the question becomes, how are we going to get there? The most plausible scenario right now, at least, given the recent data that we got, is that we're going to see a period of reinflation that will prompt the Fed to become more aggressive. If that takes place, we can be in August of this year. We see reinflation in commodities, reinflation in manufacturing PMIs, reinflation in many other categories in the economy. And the CPI actually moves higher because there is no cover from base impacts in the reading of July, which we're going to get in August. And that could prompt a Jackson Hole moment 2.0 when the Fed comes out and says, folks, we got a problem here. We're going to have to double down. We're going to have to go to 6-7%. What do you think this will do to the economy and the stock market? Because the assumption so far in both the economy and the stock market, that the Fed at some point will back off. And this point is really, really close. It could be already done. The Fed paused rates. A lot of folks believe that this is a bluff, that they're going to do 2 more. We have already reached the end of quantitative tightening. What if that assumption is challenged? That's an important thing to think about. But anyhow, I don't want this video to be too long, but it's an important question, it's an important observation that deserves to be addressed. And I hope that I did a good job here. And if I didn't, that's your problem. Anyhow, folks, that's all I got for you for this segment. But stay tuned, we have the market analysis coming out this evening. I'll talk to you later.
Credit card.